Wealth Without Wall Street Tribe. Excited to introduce to you today Mr. Mark Khuri. Mark's in the house. Good to have you, man.
Yeah, thanks, Joey, for having me.
Mark, we've talked about apartment complex in lots of different ways on this podcast, but today's topic is new to us. It's tax-exempt apartments. I don't even understand what that is. So really quickly, before we get you to tell us your mom and them background, I want the listener to know, why should they listen to the rest of this episode? What is going to be the thing that's going to make a difference for them?
Yeah, great question, Russ. So in short, we've been investing in tax-exempt apartments for several years straight now. We find them to just have some of the best risk-reward profile, lower risk, great reward in a space where, everybody's running around in circles trying to find great deals at the moment, of course. And so there's this niche within this sector that we think really provides us with outstanding overall reward and risk profile. So that's why we love it. Obviously, we're going to dive more into it, but essentially you have a niche within the multifamily space that we think is just an outstanding place to invest.
So you say that with obviously confidence. You've been doing this for a while, like investing since 2005, something like that. So why is this specific niche that much better from a risk reward profile?
Yeah, there's several reasons, and we can get into the details, but essentially what you're doing in this space is you are removing or getting abated your property taxes. And if you think about it on a large multifamily property where you have several hundred units, that could be $1 million plus per year in immediate expense savings starting day one when you acquire the property. That tax abatement or tax exemption is transferable. It's good usually for 99 years. It essentially stays with the property. And so you have a situation where you're increasing free cash flow on the property day one. You also have a situation where your NOI is going up day one pretty drastically. And so you're creating value by putting this structure in place and acquiring the property right out the gate.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Steady. That's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to wealthwithoutwallstreet.com/PIOS.
Just for Joey's sake, because I know he didn't do as much ChatGPT work as I did prior to this, why is the property not subject to these taxes? What are you able to do that helps avoid that?
Yeah, essentially there's a partnership that's created in escrow between the buyer or operating partner or sponsors and the local municipalities, where it's a public-private partnership. And what you're doing most of the time is allocating about 50% of the units at the property to be affordable by definition. So you're creating affordable housing. And in order to do that, there's a lot of different nuance, but we'll get into in a minute. But the response is you get a property tax exemption. So it's an incentive out there. It doesn't work everywhere, but it's an incentive to create more affordable housing in a partnership with the local municipality.
So this sounds like a huge win-win from the standpoint of, if we're thinking about how people keep score in the multifamily space, it's all about NOI, right? What you buy it at versus what you can sell it at. If you can, effectively pull the right levers, you can increase NOI. If you're talking about over $1 million potentially off that bottom line immediately, that's a huge lever. But my big question then would be, at what cost, right? To your point, it sounds good, but if I have to now allocate 50% of the units at some really substandard amount of, I have now no ability to increase my rents, for instance, that's also a big factor for NOI. So talk me through that. Like, why would you trade that, and what does that really look like?
Yeah, great question, right? So it has to make sense economically, or you're just not going to do it, right? And so what it comes down to, and again, not every property works, but you have to do the math, run the numbers and see, hey, if we're going to cut rents, or do we even need to cut rents in order to have the property qualify for the affordable component on 50% of the units? How much do we need to cut rents? And is that offset significantly enough by the savings in property taxes? If the answer is no, then you're not going to do it. But a lot of times the answer can be yes. You don't always even need to cut the rents, Joey, which is also another favorable situation that we get into from time to time with these properties where they already essentially qualify for the property tax exemption without having to restrict or lower the rents. And so you're essentially creating affordable housing for a long period of time going forward, and then getting that property tax exemption. And we can get into specifics if there's certain property numbers you want me to share on where we have and hadn't had to cut rents and the offset by the taxes.
No, I definitely want to get into the weeds in a second, but so give us the big rocks. In order for these things to qualify, you mentioned rents. What are some of the other criteria in order for these things to meet the idea or the requirements to become a tax-exempt property?
Yeah, I mean, again, it's an affordable component, right? So you're allocating up to half of the units at the property as affordable. And that's a definition. It's a formula based on the area median income, which is a published number in every county every year. And so, you have to be able to provide that affordability component to qualify. And it's not that simple, guys, right? This doesn't work everywhere. It's a relatively new program. A lot of municipalities just really aren't up to speed to the details or how to enact these structures. They're not participating in them, right? And so to put this type of structure in place, you've got, you need to have significant experience working directly in this area with affordable housing and within a municipality or local housing authority that understands it and wants to do it. And so usually there's a team of attorneys on both sides of the table putting this structure in place while in escrow for the buyer's side and for the local housing authority. And so it's not simple, but essentially you want to make sure that you have a seasoned team with the talent and resources to put this structure together.
But it sounds like if you're trying to think about this from the biggest bang for your buck, so to speak, you're going to be focusing on high tax areas like states or counties that have, big tax bills, because that's going to give you the biggest, kind of juice for the squeeze. What would you say, like there's certain markets that you really kind of focus in on for this strategy?
Absolutely. I mean, Texas is probably number one. We've got one of the highest tax millage rates in the country, 2-3%, and they reassess all the time. And so we've done a lot in Texas because of the friendly nature and the understanding of the housing authorities there. And of course, the high millage rate, as you noted, Joey.
Well, let me ask you this, because you mentioned that this is not simple, which sounds to me, Russ, like it's an inefficient market. Anytime that you can find an inefficient market, we talk about buying and selling raw land with the land geek all the time. And he mentions that that's an inefficient market. That's why he's able to get really high, profit margins and things like that. In this case, what are the other challenges that you face in putting a deal like this together? There may be some examples that you faced yourself that other people are like, oh, I would never want to deal with that. Or maybe that's your entree in your professionalism that got you into that.
Yeah, sure. I mean, so the way we work too, just to clarify, Joey, we're an investment management firm. And so we partner with other sponsors and operators across different asset classes. So this is one sector that we place capital into, and we do it with trusted operating partners that are pros in this space. And this is basically all they do. And so they have the resources, the team, the knowledge, the expertise to put these kinds of deals together. And so you got to have that, number one, right? You got to know what you're doing. It isn't very easy, as I mentioned, but it can work very favorably as a win-win for everybody involved. Some of the hurdles that you also mentioned, or we touched upon earlier, is that, again, it doesn't work everywhere, right? So if you have, let's say you do have a high millage rate and you have property in Texas, but the rents are already pretty gosh darn high compared to the area median income. you'll have to cut them pretty significantly in order for it to make any sense. And then it may not make any sense. And so just the sheer economics of it is another big part of the analysis, is to see, is this even worth it? And, there's properties in Austin that we've looked at where the exemption could have worked, but on paper, but it didn't work financially. It didn't pencil out because the rents were already too high based on the area median income. We'd have to cut them too significantly, and the property tax savings it didn't make it worthwhile. So, yeah, go ahead.
Mark, how is this strategy working in today's environment? I mean, there's a lot of conversation we're having right now with other investors in the multifamily space, and they're just saying today it just doesn't make sense for us to go out and buy properties where the cap rates, right, the rate at which we can earn on our cash, are lower than what it costs to go borrow money. Like, we can't make the numbers pencil. How is this strategy applying in today's rate environment?
Yeah, I love that you brought that up. So this is a big part of why we do this too. Positive leverage day one. Okay, so I'll give you an example. We invested in a property in Houston just maybe a year and a half ago. And it was a 2015 build, 215 units, right near downtown Houston. So relatively almost brand new construction. Purchase price was $45 million. The tax-exempt appraised value came in at $75.8 million because we're slashing about $970,000 of taxes day one, but we did have to cut rents by about $270K, give or take. So there's a significant offset there. All right, so that's the first benefit. But going back to more of the interest rate question, the agency lenders have special financing programs for these types of affordable properties. Another benefit, you get more favorable debt. And so on this example, our loan was 10 years fixed, 7 years interest only. I think it was about 76% loan to, 76% loan to cost. And we had a 4.94% fixed interest rate. So you have a 4.94% fixed interest rate, and then the going in cap rate when it was tax exempt was 6.4%. So about 150 basis points of positive leverage day one. And that's how we look at most of our deals, guys. It's a big part of our underwriting criteria today. We want to be able to see, around 100 to 200 basis points of positive leverage day one.
Well, so Mark, you threw out the interest rate of 4.94, and depending on when you're listening to this podcast, you may be thinking, that sounds good, that sounds bad. But at the time, if you're talking about a year and a half ago, what was the comparison to maybe another project that didn't have this? Because in my mind, it's much higher, but I don't want to assume. What would you say that was similar at that time?
Yeah, I'm just going off memory here, so don't quote me, Joey, but I believe it was around 50 to 75 basis points. So a more advantageous interest rate.
Almost in the 7% realm versus...
I think so. Our interest rate was 4.94. If I remember correctly, I believe if it wasn't affordable, it would have been around 5.5, give or take.
My bad. I didn't get my calculator out, and
okay.
Russ didn't have his shoes off the count fast enough.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
I love the idea that what you're doing is you're finding these levers that allow you to then make a deal where maybe other people don't see a deal. And that to me is like, that's super important in today's environment, is how you guys are, looking for those type of opportunities.
So Mark, you mentioned a lot of the opportunity here, right? Like you can go in, you can, if you can take a property, take it to tax exempt, now it's, gross value is going to go significantly up if we can get rid of a lot of the taxation, not only on the rent, but on the ultimate sell, because I'm assuming most of these properties you're looking to hold for a period of time and then turn around and sell them and reap the benefit. What is your strategy? Talk about the exit strategy around these. How long do you guys plan to hold them? Who are the buyers out there? Are there a number of people that are going to come and want to acquire these from you? Talk a little bit about that.
Yeah, always looking at the exit, Russ. I'm glad you brought it up. So, in this latest example I shared with you guys on this property in Houston, like we probably wouldn't even touch this property if it didn't have the property tax exemption, because there just wouldn't be positive cash flow, right? You most likely would have been maybe in a negative leverage situation, depending on how much debt we took. And so when it comes to exit, we look to hold these properties usually between 5 and 10 years, and then sell or refinance out and put on more debt, because the value's of course gone up, as that's the goal. Cash out our principal and then just hold the properties in perpetuity for cash flow. And so that's usually the exit, is either a sale or a refi with principal coming and paid back to investors while still owning the asset for another 10 plus years.
You mentioned this strategy was fairly new. Talk a little bit about like how new is this strategy, and how certain then is the exit if it is fairly new?
Yeah, I guess that's a little bit of an area of unknown, right? Because there have not been a lot of exits on these kinds of structures yet, Russ. So I want to say, gosh, we're almost in 25. So roughly about 4 or 5 years ago, give or take, there was some new legislation put in place that allows for these types of programs to be created and taken advantage of. So, but there hasn't been a lot of these properties necessarily sold. Now, you also have a lot of new construction, new builds, development of apartments that will also have these same type of structures in place. And so we think that there's going to be a pretty healthy appetite when it is time to go sell these, to already have this structure in place. It's going to be a little bit more common knowledge, a little bit more sought after, and hopefully we'll see a large pool of buyers at that time. Who's going to buy this? I mean, we think most private equity groups that are in the multifamily space are very much going to be interested, and more large institutional buyers too, depending on the size of these properties.
So I'm going to bring up just a challenge question in my mind. Anytime that I think that there's government involved in things, I get nervous, because they're just terrible, managers of money in general. And so like even thinking through like the idea of a conservation easement, we get a benefit in the terms of way when somebody limits the value of something. And so as I'm hearing you talk about this strategy, it makes me wonder, what are the things I'm not aware of that this could affect down the road? Like, does it have a limit on like who the end buyer can be in the future? Does it limit like how long you have to hold it for? Like, are there any rules surrounding it that could keep your pool of buyers or some other thing in the future that you know of at this point?
Nothing significant, Joey, that we've found in our years of doing this or our operating partners. If there was a significant risk to that, essentially the deal getting broken and that the tax exemption no longer being in place, we wouldn't do it. And so it's a favorable win-win. Now, it's important to remember that local government that's involved here, they're getting paid to participate in this venture. Okay, so this is a profitable structure for them as well. This is not just one side wins. They're getting revenue year after year on these types of programs. Okay, so
how does that work though? I may have missed that, because it sounded like to me they're no longer getting that tax revenue, right? So how does that end up benefiting them?
Yeah, they're getting a fee, so they get paid to do this. That's typically how it works, and so that's all negotiated with the attorneys. There's lots of legal documents involved, Joey, and so it's a lot of I's and T's getting dotted and crossed. But essentially, you have the land is being owned by the municipality, and the ground is leased back to usually a joint venture on a 99-year lease term. And so that's the structure that puts this in place that allows the property taxes to be exempt.
And I'm glad we're bringing up the risk, right? I mean, everybody as investors are trying to understand, how do I lose all my money? What are other risk criteria that apply in here? Obviously, when you're dealing with affordable housing, you're dealing with lower income families. My assumption is you're trying to figure out how to manage default risk within, that community. What are some best practices that you guys have been applying that is keeping the units rented?
Yeah. I mean, you end up seeing a pretty high demand for these properties, Russ, from people with all different walks of life. Because remember, 50% are affordable, but the other half are at market rate. And so you can renovate, raise the rents, make them as nice as you want. And the affordable units, they go up in rent every year based on the area median income. So again, that's published every year. We're usually investing in these properties in local areas where the area median income has been going up for over a decade. And so you're likely to see that to continue. And so the rents are essentially in line with that. But you're providing affordable housing. There are some reporting requirements that have to be done regularly with the housing authority to basically prove to them that you are following the rules of this program. You are providing affordable housing. And so there is a lot of, I would say, regulation and oversight that you have here. And so you need to have a property management team with experience that knows how to manage these types of affordable properties, right? And so the reporting requirements, the guidelines, and then the regulatory agreement that has to be adhered to is where you could get yourself in trouble. So if you're not following the rules, you could see that the property tax exemption could, in theory, be reversed.
Yeah, no, I definitely can see how you have to make sure you keep up with all of those regulations. But going back to the question around rents, right? So I understand there's a high demand from a low income area to find good housing. And if you're making these properties, you're renovating them, you're making them, better than a normal property maybe they would have access to. But still, the question begs is in a lower income, right? There's less margin, right? There's just, that's just the reality of what we live in. When things go bad, right? That group of people are the hardest to be able to make rent payments. And I've seen it in different areas. How do you guys manage that risk of applying, giving affordable housing? Because these aren't Section 8, so you're not getting money, I'm assuming, from the government for the payments, or are you?
No, yeah, good questions, Russ. So everybody has to qualify. There's no handout here. You have to have a job, you have to have income, you got to prove it. The only difference is the income requirement is lower to match the rent on those units. So if you have a higher rent in that property, then you have to make more money to qualify for it. And so what we're doing is you're creating, that's the affordable component, right? Where someone who makes, let's just say, $30,000 a year versus someone who makes $50,000 a year. And the rent might be, $1,500 a month or $1,100 a month. Again, I'm just spitballing numbers here, but you can see that someone could qualify at a lower income for that lower rent, whereas somebody who has a higher income would obviously qualify for a higher rent. So it's a similar process to a market rate unit when it comes to qualification of residents. You, of course, are doing all the screening and checks that we would do on anybody else. And again, there's no handouts here. They have to have a job. They got to qualify. The rents are lower.
Yeah, you're doing better underwriting on the front end to make sure you don't put bad tenants in. The other question I have, and this is just, I don't want to be snooty in any way, but I'm just thinking, like you talked about, half the properties need to meet this criteria, but the other half doesn't have to be, and you can, have rents continuing to rise there. That seems an interesting dynamic, right? Like I'm trying to picture, a lower income area and going into a place where maybe the rents are going up. So I don't know what that difference in price is. Is one paying $500 and one's paying $1,500? And if so, that seems like a pretty disparaging amount of money between the two people. How does that look? I mean, it just seems like a community that would be put together that wouldn't necessarily always be together.
Yeah, it's interesting. Well, I'll just mention this, that a lot of times the delta between the affordable rate units and the market rate units is a few $100, Russ. It's not like $1,000 difference a month. That isn't the difference here. And there's actually been some studies done, and we did some research on this too. Like, hey, how is this going to affect the total property, the community? Is there going to be any kind of, demographic issues? Are we going to see some people getting upset and, not wanting to live there and this kind of thing? And you can read about this, but there's been a lot of studies done where, typical Section 8 housing or low income housing is in a separate area of a community. And it's essentially surrounded by itself, by a lot of those types of housing, where when you have this mix that you see here, where it's some affordable, some market rate, you end up creating a more, I would say, holistic and organic environment that's real to how things are out our door. And people tend to thrive in these types of communities more. And so that's what we've read and learned. We haven't seen any issues at the properties with different demographics, different people, different backgrounds, and different jobs and incomes living in the same community. That we find it to be more of a benefit than anything else.
Well, now I almost wonder, Mark, I don't want to assume, but it seems to me like this would probably not be something that you would be marketing like crazy out to the world, that like, hey, we have significant discounts for certain renters, like to the masses, that this would be something that people hear about through the local municipalities, or maybe those type of government type programs that they now recognize, oh, well, this is a place, and that's done kind of behind closed doors.
Is that let's turn that into some question? Yeah. How do you market to make sure that maybe some people understand it's a different price if they're meeting a certain criteria?
I mean, it's just like anything else, right? The rent is this, and you need to make this. So it's a market rate or an affordable rate. You can market them the same way. Now, when the tenant comes in, you can tell them about the program and let them know that they qualify for this. So it's benefit for them. But that's it. You're not out there on the internet blasting, hey, we've got really low rents, come to us and nowhere else. Like, that isn't how you do it, right? You go on apartments.com and you see the same ones. Some of them are affordable, some are market rate, but you might not be able to decipher other than how much is the rent per month.
Well, Mark, I'll tell you what, you went through the gauntlet with us today. I appreciate you being willing to share. Again, this is a unique strategy. It's something we haven't heard about previously. And so, man, I'm just, for people that would like to connect with you outside of this, what would you encourage them to go?
Sure. I'd say just go to our website to start. Our company name, again, is SMK Capital Management. Our website is smkcap.com. We've got some investment examples up there, some recent deals we've done, and you can reach out to us. Happy to answer questions, get on a call and see if we might be a good fit for folks.
That's awesome. Well, Mark, thanks again for being on Tribe. If this is something that you found value in, please let us know. Do a screenshot and share it on social. Tag us on social so that we know this is the kind of thing that you're trying to learn more about on your path to get to financial freedom as fast as possible. We're always here to support you. Thank you, as always, for being here, and we'll catch you on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.